Hey everyone, welcome back to Corporate Decoder, and boy do we have a treat for you today. We're diving into J&J Snack Foods, Corp's latest annual report, and let's just say it has got more twists and turns than a pretzel factory conveyor belt. So what is the story here? J&J Snack Foods. Known for those soft pretzels and icy treats, is sharing its financial health check from the past year. We'll break down how they did, what risks they're facing, and whether they're cooking up success or just trying to keep the ovens from overheating. Make sure you are subscribed to Corporate Decoder. And if you love dissecting these deep dives with the community, join our Discord linked in the description below. Let's get into it. Alright, let's start peeling back the layers of this annual report. This is essentially J&J Snack Foods, Corp's yearly report card to investors, covering their performance for the fiscal year ended the 27th of September 2025. First up, let's talk sales. This year, net sales hit over $1.5 billion, which is a slight increase of about 1% compared to last year. Not a huge jump, but still a positive tick. They mentioned that this growth was mostly from their food service business, helping offset a dip in their retail supermarket sales. So, think more pretzels and ice cream sold at events and restaurants, but a little less moving off grocery store shelves. Now for the profit picture, gross profit, which is what is left after they pay for the ingredients and making the products, actually went down by about 3%. This means their profit margins are a bit squeezed. They're pointing fingers at rising raw material costs. Specifically, they had a tough time with cocoa prices soaring, even though they tried to raise prices. It wasn't enough to completely cover the higher costs, especially in the first half of the year. This is a classic case of input costs eating into profits. Then we look at operating expenses, basically all the other costs of running the business like marketing, distribution, and salaries. These went up by about 5%. A big chunk of this increase came from some special one-time costs. They recorded about $24 million for plant closures and another $2.3 million for something called intangible asset impairment charges. On the bright side though, they also got about $10.6 million from insurance for damage to their property. So while expenses went up, a good chunk of that was due to restructuring. And when you combine the lower gross profit with higher operating expenses, you get operating income. This is the profit from their main business operations. It dropped by a significant 28%. This is a pretty big dive and clearly shows the pressure they were under from those rising costs and the restructuring efforts. When all the dust settles, their net earnings, which is the final profit after taxes and everything else, decreased by about 24%. This translates to about $65.6 million in profit this year compared to over $86 million last year. That is a noticeable drop. Let's look at their different business parts called segments. Their biggest segment, food service, saw sales go up by a small 1.6%. Soft pretzel sales were up, driven by strong performance in the second half of the year. Frozen novelty sales also saw a small bump, mainly thanks to Dippin' Dots. However, churro sales took a hit, down over 14%. Because they lost some special one-time sales from last year. Bakery product sales did well though, up almost 5%. But even with these mixed results, operating income for this segment dropped by over 12%. This again points to those margin pressures we talked about. The retail supermarket segment, where they sell products directly to grocery stores, saw sales drop by about 3%. Soft pretzel sales were flat, but frozen novelties and handy handheld products saw declines. They specifically mentioned that capacity issues from a fire at one of their plants affected handheld sales. So, even though they had a few bright spots with new product launches, overall this segment is facing some headwinds. Operating income here took an even bigger hit, down by almost 31%. Finally, the frozen beverages segment, which includes brands like Icy and Slush Puppy, was pretty much flat in terms of sales, barely changing from last year. Beverage sales were down, but revenue from selling machines and repair services went up. However, operating income in this segment also decreased by about 6.5%, mainly due to less favorable product mix and currency issues. Now let's talk about cash. Their cash from operations, meaning the cash generated from their day-to-day business, decreased slightly. It was about $165 million this year compared to $173 million last year. This makes sense given the lower net earnings. When we look at where they spent their money, investing activities show they spent over $82 million on property, plant, and equipment. This is an increase from last year and shows they are investing in their factories and equipment. They mention this spending is for production growth and replacing old machinery. They also received over $11 million in insurance for fixed assets, likely related to that fire disruption. In financing activities, they spent $8 million repurchasing their own stock. They also note that dividends paid went up slightly because they increased their quarterly dividend. Looking at their overall financial health, they seem to have plenty of cash on hand with over $105 million. They also have a revolving credit facility that gives them access to another $210 million if needed, and they did not have any outstanding borrowings on it. This means they have a good cushion and are in a stable financial position to handle their obligations. They have what are called purchase commitments for raw materials like flour and packaging, amounting to about $133 million. This is normal for a food manufacturer and shows they are planning ahead for their ingredient needs. They also have significant operating lease liabilities, meaning they rent a lot of facilities and equipment. This totals over $161 million in obligations. Let's look at their intangible assets. These are things like brand names and customer lists that don't have a physical form but are valuable. They have almost $106 million in trade names alone. However, they did record some intangible asset impairment charges this year, meaning some of these brands are not worth as much as they thought. This is a total of $2.2 million for specific brands. They are also working on optimizing their manufacturing network, closing plants in Holly Ridge, Atlanta, and Colton, California. This led to those plant closure expenses we saw earlier totaling $24 million. And for those who like the nitty-gritty, their allowance for estimated credit losses, which is money set aside for customers who might not pay, is quite small. It is around $3.3 million. This suggests they are pretty confident in their customers' ability to pay up. So what is our take on J&J Snack Foods Corp? Based on this report, on the plus side, they have strong brand recognition, a solid market position, especially in soft pretzels, and they are investing in their future with capital expenditures. They also have good liquidity, meaning they have enough cash and borrowing ability to stay afloat. However, there are clear challenges. The company is feeling the pinch from rising raw material costs, which hit their profits hard this year, and the cost of restructuring through plant closures added another significant burden. Their sales growth is modest, and the retail supermarket segment showed a decline. They are also exposed to risks from customer concentration, meaning losing a few big customers could really hurt. The company is actively working on improving their operations and supply chain, which is a good strategy, but the impact of inflation and potential trade policy changes remains a concern. For now, it looks like a company navigating a tough economic climate managing costs and investing in growth, but the profit pressures are real. Alright, that is our breakdown of J&J Snack Foods, Corp's latest annual report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.